this was the exact reason I started investing back when I was, at GM, and here I was experiencing this a second time. And I realized a couple of things. One, the real estate investing was a good strategy. However, my specific investing strategy wasn't going to go fast enough to insulate me from this issue, right, of losing my job. So I needed a new strategy. And ultimately, I had to find a way to generate more income that wasn't tied to how much money I had to invest in my bank account. So ultimately, that led me into syndications.
Welcome to Investing for Generational Wealth. I'm John Clive from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income and cash flow, and tax benefits. Together with investors, we're renovating over 1,000 multifamily apartments and building over 500 single-family rental homes. And we're expanding into private debt, industrial commercial real estate, oil and gas, and other asset classes. Before we begin, a quick disclaimer. As always, we're not financial advisors. All investments are subject to risk, including the possible loss of the money you invest. So perform your due diligence before making any investments. And of course, consult your CPA, your lawyer, before making any investments. I'm your host again, John Lai. Welcome to today's episode, How Corporate and Technology Professionals Should Invest in Multifamily in Today's Environment, with today's guest, John Casmon. I'm so excited to have John on the podcast today. John has been in my ear for about 5 years now. So glad that we have the opportunity to talk to John. John, do you want to talk a little bit about how you got to where you are today?
Yeah. Hey, first of all, John, thank you for having me on. I'm happy to be in your ears for the last 5 years through my podcast, Multifamily Insights. And yeah, you talked about the journey. So like many of your listeners, I was in corporate America. I worked in advertising and marketing for 15 years, loved what I was doing, really enjoyed it. I worked for, in the automotive industry back at GM back in 2007, 2008, 2009. And if you recall, around that time, that's when we had our last economic downturn. And I watched a lot of my peers get let go. And that experience really led me to want to have more control over my financial future. I started learning more about real estate, ultimately moved to Chicago, started investing, and I was a guy with a duplex. So I had a 2-unit building, started making money and doing that, working in my advertising job. So I'm investing on the side. And I slowly started to build my portfolio. And one thing that happened to me was as my company was expanding, we grew a little too fast and we ended up going into bankruptcy. So this was the exact reason I started investing back when I was, at GM, and here I was experiencing this a second time. And I realized a couple of things. One, the real estate investing was a good strategy. However, my specific investing strategy wasn't going to go fast enough to insulate me from this issue, right, of losing my job. So I needed a new strategy. And ultimately, I had to find a way to generate more income that wasn't tied to how much money I had to invest in my bank account. So ultimately, that led me into syndications, which I know we'll talk about a little bit more. But fast forward, we've invested with other investors in over $145 million worth of apartments. I'm a firm believer in investing in multifamily. And the reason is you get a chance to invest in cash flowing assets that are in high demand in appreciating markets and get the benefits of owning real estate without the headaches of being a landlord yourself. And that's just a really compelling proposition, particularly if you have a great career, you like the money you're making, you don't want to quit your job, at least not immediately, but you don't want a second job or a part-time job as a real estate investor. Investing passively is a great way to go.
That's great. Thank you for the background. I'm curious to know the transition from owning the duplex to multifamily. Did you join a mastermind to make that jump, or did you find someone that was a mentor?
Yeah, well, it took some time, right? So I started off just with this idea that I think everyone has. Like, all right, hey, I'm just going to build my own portfolio. So I spent a lot of time networking and attending events. So a friend of mine, a lady named Bree, she would host this monthly meetup, and I would go every single month. So when I met her, I think I met her before we bought that first duplex. So when I bought that duplex, she kind of gave me, some advice. Check out this. You can house hack, which again, I didn't know what that stuff was, right? So, but you could live in one unit, rent out the others. So like, this is awesome. Didn't even know about this. So we ended up buying that 2 unit building. And as I was interested in scaling, the next property we bought was a 3 unit building. And then I had this bright idea that I wanted to go into commercial real estate, right? Because if I could do it in commercial, well, now I can scale. Now I'm not limited based on the loans. And the doors just kind of opened up. So I bought an 8 unit building. My wife and I saved up our money. We bought this 8 unit building. And that was right around the time when that company went bankrupt. So a couple things happened at that time. One, I was talking to that same friend. When I met her, she had 1 3 unit building. Then she went to 9 units, and then she scaled to 90 units. And I was floored. And I didn't know people could scale a portfolio that quickly. As a matter of fact, I remember asking her to breakfast to learn how she did it. And I fully expected her to tell me that, her grandfather passed away or she got some kind of big inheritance or something like that. That's all I could come up with in my head. What she actually told me was she had some investors out west who had been following her, who were interested in investing with her. And after about 6 months of getting to know each other, they decided to invest with her. And that's where she got the funding to invest in these 90 units. That was the first time like raising capital really became something I was considering. But the truth is, I didn't think it was right for me. Um, I didn't, I didn't think I knew people who had money. Even if I didn't know people with money, I didn't think they'd want to invest with me. I hadn't done that much up to that point. I hadn't even bought the 8 unit at that point. And right after I bought the 8 unit, I ended up meeting the guy who became my mentor. And when I met him, he had raised $1 million for his first deal. Now today he's got over 2 point something million dollars. I'm sorry, did I say million? $1 billion worth of real estate under his belt. And just being able to learn from him and having him as a mentor, that really helped tremendously for me. So I absolutely hired a mentor, but to be honest, I didn't hire that mentor until I was clear on what I was looking for. And I think that's a mistake that so many people make, right? You get into this space and, there's obviously lots of training options and groups you can join and things like that. But you want to get clarity on what you actually want to get out of investing. Again, if you have a great career, if you're making money and you don't want to necessarily do this as a full-time job, right? We all want, mailbox money and just to go to sleep and have checks come. But if you're in what we do is syndication, right? If you're in this business of working with other investors, raising capital, it is work. It is a business. So if you are not really trying to get another business or another job, then this may not be the investing strategy that's right for you. However, if you are open to that and you just want to leave what you're doing to do this, great. But you want to surround yourself with people who are playing the game, who can teach you how to do this the right way. So that's ultimately what I ended up doing. And that was really helpful for me to get my traction and get started in the business.
Got it. That makes a lot of sense. What has changed that you could see in the last, call it, even in the last 2 years, right? But I would say, like, since you started syndicating multifamily, what do you think has changed in the market?
There have been a lot of changes, right? So, I mean, when I first started syndicating deals, it's probably like 2017 or so. And back then, interest rates were, I'm going to go air quotes and say high, but they really weren't that high. They were in the 5, 6% range. And I remember locking in long-term debt was all the rage because we thought they might balloon. As we know, interest rates ended up dropping. And then we kind of got, really excited for these 3% rates or whatever the case would be, right? Low 4% rates. And now interest rates have shot up. So certainly the trajectory of interest rates has changed dramatically. I think also just the number of people in the space. When you have so many operators come into the space, there's a lot of competition for product. We do have a housing shortage, particularly in the affordable housing space. However, a lot of operators have come into the space, and that really increased competition where where we saw values for some of these properties just didn't align with the market. So we lost out on a lot of deals because other folks are simply willing to pay more. We're starting to see that change where those groups are not willing to pay as much now. And I just had a great call with a guy named Paul Moore. Paul Moore is the author of The Perfect Investment, all about multifamily. And I just interviewed him for my show. And Paul said something that, we agree with. And his point was, at that time, it became really challenging because ultimately you had so many groups that were, whether you call it overpaying or willing to pay a little bit more, but all of that was based on speculation, right? We are creating this scenario in the future of where we think rates are going to be, where we think rents are going to be, what we expect to happen in the future. It wasn't necessarily baked into the economics of the today and the things that we could control. You had floating rate debt. We had, maybe some folks are underwriting to, high growth rate that was above what we had ever seen. We saw in Arizona as an example where the rent growth was over, double digit, right? 10, 15%. And people were starting to underwrite to this kind of rent growth, expecting it to just keep going on, where the norm has always been in that 2 to 3% range. So some of those factors have certainly changed, and now we're starting to see the impact of that, where there's a bit of a correction that's taking place in the market. So for groups like ours, I think there's great opportunity. Obviously, we want to make sure that we're taking care of ourselves and our investors, but I think there will be opportunities for those folks in the market today.
Hmm, that's great. Well said. Thank you. Um, so how do you find an operator as investors, prospective investors in our audience? How do we evaluate? How do we find operators that we know, like, and trust?
Yeah, man, that's an excellent question, right? How do you vet operators? How do you find them? First of all, I think the most important thing is to set your own criteria, right? So go back to where I started. What are your goals for investing? Do you have your own investing thesis? And that should be based on your time frame, right? Are you close to retirement or are you early in your career? How much time do you have to actually invest? That should be one of the parameters. The other thing is, what other investments do you have? Are you banking on this? Are you looking to transition full time? Do you have kids and other obligations that you need to plan for? Keep some of those things in mind. When it comes to the operator themselves, based on your horizon, based on your risk tolerance, you should factor in, are these deals based on cash flow or appreciation or some combination of both? And to give you context, you could buy, let's call it turnkey rentals or turnkey investments in Memphis, Tennessee, that may deliver very strong cash on cash returns, but maybe they don't appreciate in value as much. The Midwest kind of has a reputation for, those kind of deals too, right? Where it's more C class, Midwest or, Southeast type assets where they have really strong cash flow, maybe double digit cash flow. But when you're done, that property is going to be worth the same amount, in the future as it is today, just because they won't appreciate as much. So that's one strategy. You could go the other end of the spectrum where you invest in new development. So the property is not providing any cash flow today, but when it's built and when it's stabilized, it's going to be worth much, much more money in the future, right? So somewhere between is a strategy that's more of a blend. That's what we do. So we focus on value add investments where we want to buy properties that are already cash flowing today, but we want to bring a business plan to increase the value and force that appreciation. So when you're looking to vet operators, what's their business plan? What's their investing thesis? And does it match your goals, your timeline, and your risk tolerance? More specifically, when I'm talking to operators, I want to understand a couple of things because ultimately it comes down to the people. And I want to know their track record. But to be clear, most people were successful from 2017 to 2021 or 22. So it's not so much just that they could show you a bunch of, positive full cycle deals. It really comes down to what was the business plan? How did you drive value? Was this just something where you bought it right and you sold it, in 12 months or 24 months just because you were in a hot market? Or did you actually drive the NOI? And one of the great examples I have, we have a deal that, we'll probably, toy around with exiting at some point this year. When we bought that property, the NOI was little around $500,000. Okay, $500,000 NOI. We are now close to almost $1 million in the NOI. So we have doubled the NOI on that asset. So we have forced that appreciation. That is not driven by the market and somebody just willing to buy our property at a 4 cap where we bought it at a 7 cap. This is us actually having the business plan, driving rents, driving operations, and increasing that value. And I think that's something to pay attention to. Again, when you're investing with an operator, are they able to execute their business plan, driving that NOI growth? Or are they, I don't want to call it luck, but, or are they more subject to market dynamics where, again, everyone kind of did well? So that's something I would pay attention to. And I would ask really good questions just to understand, hey, how much of this is driven by the operator versus just good timing of the market?
Great, thank you for that. For the attendees, if you want to drop your questions into the Q&A, please do so for John. And I'll monitor those as well. John, you talked a little bit about your buy box, value add. Is it primarily in the Midwest, or are you looking outside of the Midwest?
Great question. So starting out, I relied heavily on some of my partners, and this is one of the things that's so beautiful about commercial real estate is you can leverage the expertise of other people. Starting out, I wasn't the expert, and I go back to, and I've even toyed with the idea of raising capital. Like my hesitation was, well, who am I to raise capital? I had never raised a dollar for like Girl Scout cookies, yet alone for like apartments. So I had some hesitation, but when I realized that this truly is a team sport and I could leverage my network and some of the great people that I had gotten to know and people I believed in, and I could partner with them on deals, that kind of opened me up. So our early deals were in like Texas and Georgia and Florida. And as we kind of evolved as operators ourselves, we have focused more on kind of our neck of the woods. So we focus primarily on a 2 hour radius of Cincinnati. Think Cincinnati proper, Louisville, Kentucky, Indianapolis, Columbus. That's where most of our assets are today. We do have deep relationships with operators across the country, although we still like to stay somewhat in driving distance or a very short flight. So we will partner on deals in, say, Georgia or the Southeast region, the Carolinas we love as well, Tennessee we love as well. So we do kind of focus more on that Southeast region in the Midwest is where our focus is today.
And then in those other territories outside of the Midwest,
Yeah.
what capacity do you serve on? I'm assuming as part of the GP, is that correct?
Yeah, we focus on general partnership opportunities. We can bring our investors into the deals, but we also like to be involved in the asset management. I think
Okay.
one of the mistakes that I see people make is blindly deferring to people who may not have the knowledge, expertise, or track record to truly execute the business plan. So just because someone found the deal doesn't mean they're the best person to operate the deal. And unfortunately, what happens sometimes is, people just blindly follow whoever that leader is. For us, we've been in this space for quite some time now. We've been investing ourselves for over a dozen years, and you learn a thing or two. So even if we're not the boots on the ground lead operator, we want to make sure that we have a voice at the table, not just for us and our constituents as investors, but to help that operator. So whenever we're partnering with people, that's part of the, one of the main things we're looking for is, hey, we want to be of value to you. And we've seen some things, we can help you with things, we can tell you what's worked with different property management companies, different processes and systems to put in place, some different checks and resources. As a real time example, is February 5th. We just had a PM change at one of those assets 4 days ago. And in having gone through that, I was able to kind of talk to our team about like, hey, here's some of the challenges we face when we change PM companies. On another deal that I did, here's some watch outs. Here's some things we got to, be very proactive on. And here's some things that we're monitoring. So having that kind of background and experience, I think is really, really critical in a role we like to play in our deals, no matter whether or not we're the lead operators or partner with another operator.
Okay, thank you for that. Well, I referenced the political environment
Yeah.
and everything that's going on. How has that changed your mindset, or has that changed your mindset? Has that even affected what you do on a day-to-day, operational perspective?
Yeah, that's a great question. So I want to break that question down if it's okay with you, right? So
Sure.
I think when you develop your investing thesis, that shouldn't really shift very much, right? Your situation may change. Maybe you start off with, hey, I want to quit my W-2, or hey, I want to retire. But once you hit that goal, then your investing thesis may shift a little bit, right? But generally speaking, whatever you believe as an investor, your criteria, that shouldn't shift. Now, how you do that absolutely should be somewhat malleable. So for me, my vision doesn't really shift that much based on the economic environment or the political environment. What we may need to do is pay attention to the strategies and some of the tactics that may need to be modified. And I'll give you a real example. Just today, I made a post on LinkedIn talking about this. But recently, the new administration came in with a bunch of executive orders. One was a federal freeze on funding. And that could have had really significant impact, particularly on one of my assets, which is an affordable housing community. And we had to start talking through this. Okay, what happens if they freeze funding and we're not able to collect some of that Section 8 rental income on time? Do we need to set more money aside in reserves? Do we need to make adjustments here? Do we need to, reduce our reliance on Section 8 or subsidy, programs? Like, what adjustments do we need to make? That's a real time thing that we weren't worried about 10 days ago. Right. And that just came up based on an executive order. And, you just got to react to the marketplace. So strategically, it doesn't really shift how we approach it. But obviously, we want to make sure that we're driving a business that provides quality housing for residents. But we got to be able to collect rents as well. And if we're not going to get compensated, or that compensation is, 60, 90 days in the arrears, we're going to have to make some adjustments to that. So we're always paying attention to the policies, but our strategy really doesn't shift that much. If there's a massive policy change, then certainly we'll have to adjust our approach.
Got it. Okay. Thanks. We talked a little bit before we started the recording. Would you and your team ever consider branching outside of multifamily apartment syndication, right? Are there other asset classes you're interested in, or doing other types of businesses that you would be interested in, maybe adjacent businesses?
Yeah, so I think there's two ways of thinking about this, right? We all look for diversification in our portfolios, and I think it's really important to have. With that said, our bread and butter is multifamily because it's one of those things that you can always learn a little bit more about. You can always get a little bit more efficient in your operations. And I'm a little concerned, or I get a little nervous when I see kind of jack of all trade types. Now, it's a little different if you're focused on the funding and investing with operators, but like you're focused on kind of getting the capital together and you're allocating capital. But if you're an operator and you're operating in five different asset classes across, multiple states, and just the more variables you throw into it, I think it creates more challenges and more complexity than necessary to be successful. And I'll give you another real world example. I alluded to the property management change we made. Well, the experience I had with that came from a previous property management change on one of my assets. The great thing was I was able to take the managers on our property in Louisville, and I already had a built-in relationship. The regional manager, we have, biweekly calls, great relationship there. I let them know, hey, we're going to need to make a change here. Is this something you all would be interested in? She said, yep, why don't we meet at the property? Let's go through it. Met her at the property. We talked through what the business plan would need to be. They took on the asset. I've got one regional now that's taken on both of these properties. You can't get that kind of simplicity in the execution and being able to adjust to wild changes. And to be clear, a property management change is a fairly significant change, right? This is the person that's overseeing the day-to-day of the asset. So that entire company changing is not a small change, but to do that seamlessly and have kind of the answer built in, ready to go, and actually have it work better for you, that requires deep relationships and deep expertise in the market where you can execute. And that's harder to do when you're across different asset classes and in five different states. So that's why we like to focus there. With that said, I do think that there are some areas that are very exciting and enticing to me. Senior care is one. I think there's a lot of opportunities in the senior arena, whether that is in-home senior care, residential assisted living, whether that is 55 plus communities. There's lots of different ways to go about it, but I do think that there's this growing notion and growing opportunity within the senior community. The other thing that we're looking at is kind of real estate adjacent industries. So we've started to explore, hey, is there a complementary business that we could launch, or is there a franchise that makes sense? Now, that really would be more of a personal investment at this point. There could be an opportunity for us to bring in other investors, but I would like to keep kind of what we do at Casmon Capital Group focused on multifamily investing. If at some point that expands to senior care, I think that's a natural fit. but we'd want to keep it kind of in that arena. And then, yes, I want to explore other stuff. If we have success, if we feel like we've got great operational partners, or we have the team to execute, at that point and only at that point will we feel comfortable extending that to other investors.
Yeah, that makes a lot of sense. And then the senior living makes a lot of sense with the demographics skewing a little heavier toward, retirement community. That makes a whole lot of sense. I see that in Portland, where I live, and I'm sure that exists everywhere else as well, not just in Florida. Um,
Everywhere, everywhere. And the thing is, like, there's a stat that I heard a long time ago, and it's one of those things that's like a slow drip for me. I had interviewed a guy named Gene Guarino, and I interviewed Gene. Geez, I don't know, like literally, he was one of the first year of my podcast, like 7 years ago. And Gene said that 10,000 people turn 65 every day in America. And that stat just seemed astounding to me. And I looked it up,
mhm.
and Gene's telling the truth. Gene has since passed away, but his daughter Isabel has taken over the family business. But they run Residential Assisted Living RAL Academy. And I had Isabel come out. She spoke at my Midwest Summit we did a couple years ago. And I talk to a lot of investors all the time, right, in this space. I got a lot of friends in the industry, love watching them present. Isabel had me completely engaged. And she said something that really caught my attention in a way a speaker in this real estate industry has never done. And she's a great speaker, to be clear, but it wasn't so much just like this eloquence of her words, it was the reality hitting me. And what she said was, based on the aging senior population, we're basically talking about our moms and our dads. If you don't think this is something you need to learn about, you are probably massively mistaken. And here's why. If you are the person in your family that's the most financially well off, if you're the person in your family that is the most responsible, when those parents age, your siblings, your family, they're looking at you, right? So whether you're doing it as an investment or just, hey, we're gonna have to do something with mom, do we want to put her in a home? What do we want to do? They're looking at you. And as I sat there and reflected, I'm like, well, that's absolutely me. And on top of that being me, it was, wow, this is a responsibility that I'm going to probably have to explore one way or the other in the future. So why not learn about it from the investor lens? And even if it's just to start to understand the inner workings of this space. So when it comes time to do something with mom, I have a better sense of my options and where I want to take her and things like that. So I just thought that was something that was really, it's personal for all of us, right? I mean, caring for our parents is something that we all are going to have to deal with in some capacity. At the time, my mother-in-law, she just passed last year, but this was the
Mhm.
conversation we were starting to have was, hey, mom's at that point. We like having her at home. She's not getting the care she needs. We need to do a little bit more. So we were starting to have those conversations before she passed. So it's just something that, again, whether it's from the investing lens or just simply the own personal implications we all are going to have within our own families, it's something that I think people need to wrap their heads around. So understanding what that space is like, I think is helpful for many of us.
That's great. Thank you for that. Yeah, I think my parents went through the same process as well, and they eventually chose like just stay at home. But yeah, the long-term care plus senior care together, it definitely has signs for not necessarily opportunity, but there's a demand there,
There's a
right?
strong
So
demand. There's a strong
yeah,
demand. And again, whether you want to take advantage and be involved or be a part of the solution, that's on the individual. But the
yep,
reality is that demand is going to continue to grow over the next, 10, 15, 20 years.
yeah. Um, can we talk a little bit about your team? Like, how is your
Sure.
team comprised? And there's property management, it sounds like. There's probably some acquisition slash underwriting team, right? Talk a little bit more about that.
Yeah, so we try to run a lean operation, right? I think one of the things that I've seen happen is teams start to expand and blow up and they hire a whole bunch of people. And now you've got a heavy overhead that you've got to account for. And what that means is you've got to generate way more revenue to account for this overhead. And you may end up doing deals that are a little more thin than you would like to do. So we try to keep our team a little bit lean for that standpoint. The way we operate, we have a couple of kind of employees, a couple of vendors that work very closely with us, or we're kind of their main or only vendor. And then we have some strategic partnerships. So we use that model because it's just easier for us to not have to float a bunch of overhead. It's basically you get paid when you perform type situation, which works well, and we can bring those individuals in as partners. On the operational side, we do have third-party property management companies that we work with. We try to make sure that we do a great job vetting those partners. It's always a little tricky, but when you get partners, people understand how you like to operate, when they prioritize people, when they prioritize the residents, when they understand how to drive revenue, they understand how to get results. That makes life a little bit easier. But the truth is, it takes time to get there. We've gone through a number of property managers and property management companies to identify those that work well with us, and that's part of the process. And I kind of go back to where we started the conversation. If you're a full-time professional and you've got a career, how much time can you really dedicate to vetting PMs, particularly on like a house or a smaller asset, right? Like this is somebody who's making like $100 on your property. How hard do you think they're going to work to make you $100 in profit monthly, right? Like it's just not realistic. So you've got to factor in some of these things. And as you know, it's harder and harder to find great help today. So with that said, you kind of have to make sure you build an infrastructure to vet great employees, team members, to retain them, to keep them motivated. And that just requires, kind of some diligence in order to kind of set those parameters in place. So for us, it's about having the right people, having the right partners, but also recognizing when it makes sense to scale up and get aggressive with your actions. Again, actions, not necessarily numbers, but underwriting more deals, having more conversations with brokers and being more active in the space versus, hey, you know what? It's really tight right now. If we find one that's a winner, we'll certainly do it. But we also recognize that it's unlikely for us to find that deal in this environment. So you do have to kind of stay active and keep your ear to the ground and understand what the environment is and try to make sure you're ready when the opportunity strikes.
Two follow-up questions on that.
Yeah.
The first is, have you ever thought about being vertically integrated with, property management, for example? That seems like a natural fit, unless it's just property management for one complex. Typically, it's better to have a property manager sit on multiple complexes in the same kind of region. But have you thought about vertical integration? And then the second question is, maybe a separate question altogether is like AI. Have you thought about leveraging AI?
Yeah, on the first question, yes, we've thought of it. We've tried it. My
Mhm.
partner was based in Denver. She's moved to North Carolina, and our properties are in like Northern Kentucky. So we had vertical integration in property management. It was really a challenge managing the on-site managers. So we got to the point where, you're trying to figure out if they're actually doing what they're saying they're doing. I'm spending a lot of time just verifying and validating that they're at the property, checking the tenants reports and checking kind of the requests and tickets to make sure things are being processed. And the truth is, it just wasn't the most efficient use of our time. Where I think it makes the most sense is when you're able to scale. Most people will tell you, hey, if you can get to 1,000 doors, being vertically integrated makes sense. It doesn't have to be 1,000 of your own doors, right? You could have 200 doors and maybe 800 that you manage virtually or through a third party rather. But you want to have some level of scale to be able to bring in those key components, right? That regional manager, the on-site managers, the maintenance technicians to get those contracts and those vendor relationships for third party suppliers. But it does take some work and some time to manage that. The truth is, though, I don't want to manage a property management company. Like that's not the business I want to build. If you talk to any property management companies, they will tell you that it's probably the like least efficient and the least valuable part of any real estate. Like you want equity in the properties. Now, it's a necessary evil. You need it, right, to make sure these properties
Mhm.
are being executed appropriately. And that's where it comes down to what are your options? If there are no better options, then you probably need to focus on that and be able to scale up to make sure that managing those properties is worthwhile. But if you can find competent third party management then I think it does make sense to go that route, at least while you're getting traction early on, because it could become a big time suck if you focus on that too early. The second part of your question was about AI. So there's definitely some great AI technology, not just AI, but just technology in general. So just understanding how to leverage scale, virtual assistants. There are tasks that property managers do and companies do that can absolutely be outsourced. And just taking a fresh look at that approach, I think makes a lot of sense. So that's something we're starting to explore more and more in the business to say, hey, does my on-site PM really need to do that task, or is that something that we can take off our plate and have that process handled by someone at a call center or someone who's sitting at a desk on the other side of the world? So if we can figure out ways to be more efficient, those are the kind of conversations we're having in 2025 to be better operators and, quite frankly, to get more value out of everybody.
Got it. Got it. We do have one question that came in. What are some of the best resources for senior living investing? Back to senior living.
Yeah, great question. So, I mean, we are not in the senior living space now, so we're still wrapping our heads around it. So, I would tell you, do your own research. And senior living's still very vague. There's so many slithers of it. There's again 55 plus communities. There is residential assisted living. There's senior care, which is in-home senior care. So you'd have to figure out first and foremost like what you're actually interested in. I would start by, certainly Googling some things. RAL, I know, has some great resources and some great information available. Again, that's Isabel Guarino's company, is our RAL Academy, I believe, is their education platform there. But I know they've got some great stuff. Assisted living facilities. I know a lot of folks who have invested in those over the years. So certainly start by listening to podcasts. Podcasts like mine. I've got some episodes with RAL providers, so we can certainly share some of those with you in the future. But you got to wrap your head around it a little bit more, figure out what you like, what you don't like. Do you want to own the real estate or not? I think one thing that's a little bit different with the senior space than say multifamily is with multifamily, it's very common for us to own the real estate, but not the property management company. And yes, you could be vertically integrated, but that's more of a preference. With senior living or the senior care facility in general, senior care in general, there's two different businesses, and you've got to ask yourself, do you want to own this business, or both businesses, right? Because you can own a senior care facility and have a complete different company actually manage or execute the senior care services.
Right.
You could own a senior care services business and not own the real estate, and you could obviously own both. So there are lots of different ways of mixing and matching that. You're definitely going to be involved with, licenses and, just a lot of management of people. Obviously, these are seniors, so you're gonna, work with parent, loved ones and children, things like that. So there's a lot more involved, and I think you just have to be clear on, is that a space you really want to get into?
Yeah, I would imagine there would be more either regional or statutory regulations as well for senior
Absolutely.
living.
Yeah. Yeah. Absolutely.
Um, it's good. Okay. I would definitely encourage others to put in their comments. What do you think, knowing what you know now, and going back to 2017 or earlier, what would you tell a younger version of yourself?
Oh my God. I going back to 2017, 2018, there was a lot of pessimism in the industry. And I feel like there's been pessimism around multifamily investing since I started. My first couple of years were, looking back, great because we were coming off of the economic downturn. So we were watching prices rise. However, I would say around 2016, that sentiment started to shift. And by 2018, there was a lot of people who were saying, oh, it's going to crash, it's going to crash, it's going to crash. Very well known people, high profile individuals. And I remember selling an asset very prematurely, partially, if not 50% influenced by the feedback I got from some really well known and well respected people that, hey, this thing is about to crash. You probably want to liquidate and get into cash. And of course, that property went up in value and market did great and went on a historic run. So, one thing I would say to myself is, hey, man, just buy quality assets. Don't worry about the future. You can't control the future. Don't get caught up in the headlines. Don't worry about a crash. Buy cash flowing assets, put the appropriate debt on these investments that matches the business plan and just make solid investments. Don't worry about the future. I think when you're new to the space, it's easy to get influenced by folks who, go on TV and maybe have great titles and have done a lot more deals than you. But the truth of the matter is, no one knows what's going to happen in the future. Everyone's just guessing. So don't worry about that stuff. Don't get so caught up in the economics. They're all guessing, and by the time you think you figure it out, it's going to change anyway. So focus on your investing fundamentals, your investing philosophy. Buy quality assets with the right business plan in place. Understand how to mitigate your risk on these deals, and you'll be fine. So if I could go back and do more of that and not worry about what might happen next year or what this president might do or don't worry about that crap. Just buy quality assets.
To that end, could you talk a little bit about um, your sourcing pipeline, your acquisition pipeline, and how that works? Like what your buy box is, and then
Yeah.
how you look for your assets.
Yeah, this goes back to, your investing philosophy, but being somewhat fluid on the strategy. So
Mhm.
if you would have asked me this question 18 months ago, I would have told you we look for value at multifamily, 100 plus units, in the same markets, Cincinnati, Indianapolis, Columbus, Louisville. Today, we are opening that up to smaller assets, say 50 plus, maybe even 40 plus. And I would say we still like value add, but we are also open to properties that don't need as much work and maybe are a little more stabilized with longer term debt in place. And we're also open to properties that may need more work. But we could be not necessarily vertically integrated, but we have kind of more control over the entire operations of the team. And the reason for that is we think it's less about this magical buy box and more about the opportunity. We know that there are a number of investors who are, looking to exit their deals right now, whether it's mom and pop investors who have owned for 20, 25 years. They've seen the market kind of go up and maybe they hung on a little too long. They've been waiting to retire, they've been waiting to get out, and now they're just done, right? So we're now investing to find those investors. Or we know folks who, again, maybe paid a little too much a few years ago, they're either upside down on the payments or they don't have much equity and they need to exit as well. The loan is getting ready to balloon and, they're either going to have to do a cash in refi or the property may go into foreclosure. So we want to be open to those kind of opportunities. So for us, what we have realized is sometimes it's not as much about this perfect deal that we draw up on paper and more about the opportunities where we could solve problems. So we're focusing a little bit more on that as opposed to seeking this deal that fits our magical buy box.
That makes sense. Thank you for that.
Yep.
We're coming up on the top of the hour. So, one question that we always ask our guests is there's a couple of questions. One is, besides the bankruptcy, what other investment did you make that didn't turn out as you intended it to? What are yeah.
Yeah, well, I mean, the bankruptcy was that was my employer, so it wasn't my personal
That's true,
bankruptcy. That was
yes,
the
yeah.
employer. But yeah, I would tell you there are a couple things, and I love that question. By the way, you asked me about due diligence earlier for operators. That's a question you should ask, and the way I like to ask it is, tell me about a deal that didn't go according to plan. And
Mhm.
it doesn't necessarily have to be a deal that failed, but we all know no deal goes 100% according to plan. And I like to listen for accountability, but also kind of a lesson learned in that process. So I'll tell you, when I was getting ready to scale, when I was coming out of that second company going into bankruptcy, um, I really realized there were two ways to invest in real estate without relying on your own capital. One was raising capital, which is one of the pathways we obviously went down. The other was flipping properties and then taking the equity or taking the proceeds from those flips and reinvesting it into longer term holds. I had the bright idea of doing both. By the way, at this time, my main job went into bankruptcy. I have two children under three and I've I'm trying to start the syndication business. I'm launching the podcast, and now I'm getting ready to do this flip project while working this full-time job that is unstable. So I had a lot on my plate to say the least. And with the flips, I had the bright idea of, hey, you know what? I don't know everything. There was this guy who was a developer, and a friend of mine had actually just partnered with them. And they were doing these like trolley tours to show their flips. So he was showing all of his developments, like, hey, here's what they look like. Here's my plan. Here's how I do this. So we went around and we looked at 5 different houses. Loved the business plan. He had his whole team in place. He had the contractors there. He had the real estate agents there. He had other investors there. And there are like 40 people on his tour, right? It's not like just me. So we're all in his tour. We're all watching what he's doing, how he's building it, how he's almost got like the Henry Ford of flipping. He's got a whole pipeline. I'm like, this is brilliant. He's buying the same kind of property. He's doing the same renovation to every single property, and he's creating a ton of value. And I'm talking to the other owners, and they're like, yeah, we sold it for this. I made this amount of money. Great. So I'm like, awesome. I'm going to sign up. I'm going to do this. Sign up and do this. My wife had some reservations, not because she was concerned with anything about investing. She had concerns about him and his ability to manage growth. And I ignored her concerns because I'm like, oh, you just don't see the vision. Nah, this is going to be great. Let me tell you what happened. Once that initial high wore off for me, I sat down with him and I realized when he was starting out on that tour, he had 5 houses at various stages of completion. After I signed on board, he had 7 houses. Okay, not that big of a deal, but we're starting to grow. And then very quickly, within about 6 weeks, he had 8 houses. So now I'm like, hey, man, you're almost double where you were as far as the amount of the work you're getting done. And I didn't see any new crew members. You didn't add any construction crew, anything like that. So I asked him, I said, hey, how are you going to manage the growth? Are you going to add more crews? Are you going to add another GC? And he said, hey, man, don't worry about that. I got it. You just focus on funding the deal. And that was the first red flag. But honestly, that should have been like the siren to just try to pull out whatever I could and get out of the deal. Fast forward, as you might guess by now, he was not able to manage the influx of work that came on board. He has essentially built a shell, this house of cards, where he would take draws from one project, put it into other projects just to move them along far enough to get another draw. And he just kind of kept this in rotation. So we would go weeks and weeks at a time where nothing was being done at our property because he was waiting to get a draw. And he would just focus on whichever property was closest to getting the next draw to keep
Right,
this house of
right.
cards going. One
Jeez.
day he calls me, he's got some issue going on, and it just became clear he was not going to work out. I ended up losing a considerable amount of money on that project. I had to take it over myself, get contractors to finish it and close it out. But the lesson was twofold. One, trust your wife, talk to her and make sure you don't dismiss her
Yes.
concerns because
Yes,
she
yes,
has really
yes.
good questions. The
Yeah.
second was make sure when you're vetting people, make sure that they value your feedback and your concerns because if it's a real concern you have, either one of two things should happen. One is they should be able to explain to you how they're going to mitigate that risk or that risk is not likely to happen, or they're going to take that into consideration and make adjustments so that they can address it. But either way, if it's a concern to you, they should treat it as a legitimate concern and not be dismissive. And when you have people who are dismissive, that is a sign to just run for the hills.
That's great. That's a great story. I like it. I always, whenever I invest with a new operator, we do thorough due diligence, but it's almost like, crossing your fingers, crossing multiple fingers and making sure that things work out. But
Yeah.
they've worked out for us. But we, again, part of what we do and part of what a investor that is doing their due diligence should be doing is like investigate,
Yeah.
right? And look into the operator, look into their dealings, check, their investors and see if they're satisfied. So, um, the other question I ask is, what do you do to give back to your community? What have you done in the past?
I love it, man. So there are a couple of ways we like to give back. One, for our real estate and education community, we have our podcast, Multifamily Insights. We try to have conversations like this and share the lessons we've learned along the way, the lessons other investors have learned along the way, and share that with as many people that we can, those folks who are interested in multifamily investing. So you can find that wherever you listen to podcasts, but it's Multifamily Insights, great podcast that we've been doing for 7 years now. On top of that, we have a sample deal package on our website. And the reason we put this together was I know I personally was having a hard time wrapping my head around what this looks like. I would talk to people and they would talk about syndication and, oh, it's going to be a 7 or 8% pref and a 70-30 split to us. And I'm like, wait, what? What? I needed to see it. And what happens for most investors is when you see it, it's on a live investment, right? Somebody's asking you, do you want to invest in this deal? And I felt like people need a minute to like digest this information before they see a real investment opportunity. So we put together a sample deal. It's not based on a real deal, but I did like pull together information from multiple projects I was looking at. But if you want to wrap your head around like an offering memorandum and what you can expect to see and what to look for, you can check that out on our website, casmoncapital.com/sample deal. And then outside of real estate, I have a friend who, actually a friend of my wife's, she launched a nonprofit and it really touched me because when I was in corporate America, the last thing I was doing was working in the alcohol space, doing marketing and advertising for some alcohol brands. And not necessarily the most fulfilling thing in the world, right? I mean, it's fun, but I wasn't making a huge difference on this planet. And she was out and she had launched a nonprofit to provide clean drinking water, and not just water, but sustainability to underserved communities. So as I'm listening to her talk about this nonprofit work she's doing, and she launched it and the challenges she had, I'm like, wow, I need to be doing more. So I asked her how I could get involved. She needed some help with some marketing things and needed some help on the advisory board. So I joined that advisory board, and that has been an absolute pleasure. And I've been on that board for like 6 or 7 years now. But it's called Surge for Water. And what we do is we invest in sustainable water solutions in these developing countries like the Philippines, the Dominican Republic, Uganda, and Haiti. And it's not just about bringing water there, it's about teaching the people and helping them build the infrastructure so they can end the cycle of poverty. So that's something I'm really proud of. I was able to get some friends and some of my investors to come to our gala this past year. That was just a great experience and a great opportunity. So that's one of the things I'm very passionate about. Just serves a great purpose. And the more we can do in that space, I think the more important it is to give back and help other people along the way.
That's fantastic. Thank you for that. Uh, I think you mentioned a couple of ways people can get in touch with you. Are there other
Yeah.
ways that people can reach out and get in touch with you?
Those are two of the best. Multifamily Insights. Just check out the podcast, the
Mhm.
sample deal. Once you get that, you'll be on our email list, so you can just respond or let me know if you have any specific questions. And then I'm always available for a quick call if someone wants to do a discovery call about working with us in any capacity. Happy to jump on a quick 15-minute discovery call. You'll find the link to that on the website. So if you go to casmoncapital.com, all the resources are right there.
Perfect. Well, again, thank you, John, for the time and taking the time out of your day to speak to us about multifamily syndications and your past experiences. Don't forget to like and subscribe to our podcast or webinar and on whatever platform you're listening to so that we can bring you similar type of excellent content like today's content with John. And thank you again, everyone. Until next time, keep investing for generational wealth. Thanks, everyone.